This is the daily fiscal pulse for the 14th of August, 2026. A quick note up front. We're looking back at what happened through Friday's close, not tracking live data as it moves. Let's start with the broader landscape and what's capturing investor attention right now. Artificial intelligence and technology stocks are dominating the conversation. The story making waves is Meta's legal situation in California, described as having astronomical consequences as the case reaches a pivotal stage. That narrative is clearly bleeding into market behavior. Let's see, though, what the actual flow of money is telling us underneath the headlines. When we look at today's actual fiscal numbers, the net transfer came in at $7.6 billion. Tax receipts generated $14.5 billion and served as the primary engine behind that figure. On first glance, nothing stands out as particularly remarkable. Yet the market is holding its ground. ES futures settled at 7,806, which is above the 20-day moving average sitting at 7,615. Across that 20-day window, the range extends roughly 493 points. What's interesting is prices aren't cracking despite headwinds on the fiscal side. Movement has been relatively consistent throughout the period. The 5-day average comes to about $9.6 billion daily, which tracks closely with the 20-day average of $10.6 billion. The cadence of money flowing into the system hasn't shifted dramatically in either direction. Zooming out to the annual comparison tells a similar story. Spending for the fiscal year to date stands at $1,515.8 billion, representing roughly a 10% decline versus the same window last year. That's a substantial pullback in fiscal support reaching the economy. If you're carrying long positions, it's worth confronting the fiscal reality straight on. The current environment isn't delivering much tailwind at all. Our conditions gauge is tracking at -66. That said, history provides some useful context here. We've encountered these kinds of conditions multiple times, and even as liquidity has tightened, the S&P 500 has still managed to average around plus 1.5% over the following month. Stocks don't necessarily move in lockstep with liquidity. Often they just keep grinding upward anyway. There's a positioning element worth flagging as well. Leveraged funds have kept piling into long bets while margin debt is now sitting in the 96th percentile. That's elevated territory. Historically, these kinds of readings work more as a caution signal than a thumbs up. So what does that mean in practical terms? Fiscal flows are running below year-ago levels, which means the shock absorber in the system is thinner. When sentiment turns positive, equities can continue working higher without much resistance. But when a risk event surfaces, perhaps an escalation in the AI or tech space, selling pressure can intensify much faster because there's simply less liquidity cushioning the move. A couple of calendar dates are worth circling. The 15th of August marks the Treasury coupon interest payment window, and it could mean a substantial reserve injection that reshapes near-term flows. That's the next significant Treasury coupon interest payment date on the schedule. So yes, fiscal drag is plainly visible in the numbers we're seeing, but the rate at which tightening is happening may be steadying out. What comes next probably hinges on how these scheduled flows actually land and impact the system. That's where the edge sits right now.